let's just begin real quickly on what Bill Gross said to us earlier in the programme. He talked about, having a lot of cash in his portfolio, duration of -1 to 2 years, for example. And he also mentioned how credit extension is risking another recession, and he believes a lot of positions will be liquidated and a lot of defaults will happen that wouldn't maybe necessarily be on the cards right now.
Well, I believe we're sowing the seeds for those defaults to come later, but not really right now today, because you have a pretty perfect mix of stronger economic growth, capital markets are open for companies, and companies are issuing a lot of debt. Companies are issuing debt with weaker covenants, so defaults will come, but it'll come on weaker economic activity, not today. So default rates of around 2 to 3% is what your viewers should expect in the coming year. But beyond that, there's going to be a big default cycle, because we're very late in the economic cycle, 8 years into economic growth, and in the last recession, we saw 300 billion of defaults. Right now, there's only about 60 billion of defaulted paper. So there is some defaulted paper to be able to invest in, but most of it is going to come on the horizon.
So you say 2018?
2018, late 2018, perhaps, it's hard to pin down at this point in time, but I don't think it's this calendar year or in the next 12 months.
And just because we're late in the cycle, in the sense of maybe being long in the tooth of a cycle, does that necessarily mean there will be a catalyst that will send us into recession?
Well, the catalyst can be multifaceted, but one thing that typically, causes recessions is Fed continuing to hike interest rates, and we see that throughout many different cycles. You also see when the employment index gets as low as it is, 4.3%, it's harder to hire people, though we haven't seen wages start to tick up. We expect that to be coming too. And so those are a couple signs that we'll be looking for. But given where we are in the economic cycle, we do think it's forthcoming. And one interesting thing to note, because I mentioned the whole complex of distressed debt today is around 60 billion, is Puerto Rico alone is 72 billion. It's not in that index because it's municipal. And so although distressed managers may have a little less corporate debt to invest in today that's truly distressed, there's Puerto Rico, which is a pretty big name in the market.
Just on that particular piece of news, what did that mean to you and to other bond managers? Did it set a precedent? Was it a big shock? Were you anticipating it?
We were anticipating it, and we acquired our positions at what we thought, attractive levels to enter Puerto Rico. I think the bigger issue right now is the restructuring, because you have PROMESA, you have the Title III, which is a hard restructuring, and you have Title VI, which is a consensual or a pre-pack deal. And so you take PREPA, for instance, where there's $9 billion in debt. The creditors have all come together and agreed to a plan. The debtor, which is PREPA, the Puerto Rico Power Authority, has agreed to the same plan, so they're in agreement, and the governor has agreed to it. And the one holdout is the U.S. Congress appointed Oversight Committee, and they have yet to opine, and we're curious whether or not opining at this point because there's dissension from within or because they just can't make up their mind. But when the creditor and debtor agrees, usually the bankruptcy judge approves the deal. In this case, what they're doing is holding up the deal, and the worst thing you can have for the Puerto Rico island is to continue to push this problem down the road and not address the issue. Given
how it all transpired with Puerto Rico, would it make you more or less likely to buy other debt in other places, I don't know, Illinois or
Well, I think the next, no, because I think every situation's unique, but I think the next big, huge, non-corporate sovereign-like is Venezuela, and that's also a 2018 item.
Are you in yet?
We're not, purposely, because of the regime or the leadership of the country, Maduro and so forth. But there's $70 billion of debt that's known, and there's another, we think, 40 to 50 billion sloshing around that's been privately issued by the government. So we think there's up to 120 billion. To put that in context, Argentina was only around 95 billion. And so it's a bigger default that's on the horizon to happen than Argentina was when Argentina defaulted back in 2001. And so we're watching that closely as well.
It wouldn't scare you that you might be in for years of litigation, dealings with China, all sorts of creditors, these so-called hunger bonds?
Well, we're not in now, and we certainly don't want to, take a position in the, quote, hunger bonds. And we'll assess it all later, and one of the assessments will be is who's leadership then, who's the president of the country when this finally comes to bear, because there may be a change of leadership at some point when there's a restructuring.
Okay, a few really quick questions. You had been letting cash pile up. How much more cash are you letting pile up, given that you're anticipating a rise at some point in the next 12 to 18 months in default rates and potentially nominal high yield rates?
So some of our distressed positions come to fruition by turning into cash because we get paid off at the end of a restructuring, or our debt becomes listed equity, which we can sell, and so we monetize it that way. And so as we monetize investments, we're not reinvesting right now. In fact, what we're doing is adding slightly to our shorts.
Where are you liking shorting right now? Is it all retail, or are you still finding energy?
Well, energy is very interesting, and the reason why energy is so interesting right now is if you look at WTI, it's down around 12, 14% year to date. And if you look at the price of the ETFs or the individual stocks of these high yield energy companies, they're down around 25%. But yet high yield bonds,
which we just looked at on screen,
okay, are up around 2 or 3% in a year. And so the market's telling you something. And the question is, what's the market telling you? That debt is overvalued, that equity is undervalued, or that perhaps that debt investors are expecting higher oil prices and equity investors are expecting lower oil prices, or maybe it's just an earnings story and not a debt story at all. And so we're assessing that, and we've certainly added to a couple shorts in the energy space.
Bruce, I want to ask you about infrastructure, because I know a lot of it is investment grade, but are you finding any infrastructure plays here, given that the president seems to be continuing to, profligate his infrastructure ideas?
There will be some terrific infrastructure investments to be made in the coming years, because this country is short. As great as we are and as productive as we are, we're short probably $3 trillion in infrastructure. And the president throws out a number of $1 trillion need that the government should spend, but that's probably $1 trillion matched with $1 trillion on the private side. So the public-private partnership that should exist, whether it's privatization of airports or the air system, FAA, or whether it's building out bridges or tunnels, this is an important topic for our nation, and there's going to be lots of equity needs and lots of debt financing needs.
Are you in anywhere yet?
We're not in anything yet. We will be, but there's other forms of infrastructure, say LNG plants and big utilities, and there we have positions, but that's not the true infrastructure we're talking about right now.
Okay, I have to ask you about, given the UK election tomorrow, Europe, Brexit, any other opportunities around Britain, or are you staying completely out? And what about the European banks? We just saw Santander take over Popular. Yeah,
Banco Popular, I mean, that's just remarkable. Imagine, Vonnie, you have the chance to buy a bank with $147 billion in assets, and you put down on the table £1.
Yeah,
that's the price, £1.
Isn't it funny how
it's not $2 a share, it's not $10 a share, that's worth zero.
If only we could think of a historical precedent for a couple of dollars to buy a.
And so it's it's Jamie Dimon, JP Morgan buying Bear Stearns, essentially zero is what happened yesterday. As you wiped out the equity, you wiped out the AT1s, you wiped out some of the tier 2, and and just turned. No good bank, bad bank, but this is truly a U.S. solution for a European problem, and so we applaud Spain. We think there's lots of opportunity comes out of that. We think Italy is sitting on their hands right now, so Italy to the ECB and to the Italian Banking Commission, get off your duff and get going in Italy, because you have the same needs to do in Italy, and with that, we're becoming more bullish on Southern Europe, and so Southern Europe, previously labeled the pigs, right, including Portugal and Italy and Spain. You look at the equity prices, they're up 20 to 25% this year in euro terms, 20 to 25%. And these economies are balancing, and there's lots of opportunities for us to buy NPLs and to help finance some of the new growth that they have.
All right.
So we're bullish on Southern Europe.